Welcome to the last of our advanced PortGen sessions. Today, we're going to talk about financial considerations. We have a subject matter expert here with us today from the Small Business Development Center, Steve Burke, and he's going to talk to us about cash flow forecasts. That sounds pretty exciting, doesn't it? It's essential information that you're going to need to know to be successful in government contracting. We're going to talk about statements of qualifications. We are going to talk about the 7 C's of financing: cash flow, collateral, capacity, capital, credit, character, and condition. Steve is going to guide us through this session. It is going to be 2 hours, and most importantly, we are going to join together at the end for the Q&A. So stick with us. We're going to close this session and then Q&A. So if you are going to have any questions you want us to answer, Steve, let's go to the next slide to talk about logistics for today. All right, so this session is going to be recorded, and support documents will be also available to you. And then we are going to post this out on the Port site. This is the link that you can find this recording. It will take up to 10 days to edit this and get it out there, but it will be available. If you have any questions, please put those in chat directly to the moderator, which is Lisa Lagerstrom, myself. And please consider taking the post survey. It helps us understand what was very informative, what we could do differently, and we always appreciate the feedback. So with that being said, I'd like to pass this over to Steve, and he's going to start off the day. Steve?
Well, thank you, Lisa. Appreciate the opportunity to spend a few minutes covering the kind of things that we talk to our clients one-on-one about. I see that one of my colleagues has joined us, Ann Zimmerman, who is our advisor in Tacoma. She's also a CPA. She has seen at least parts of this presentation before. So she's one of those folks that can help answer some of the questions as we go through this, because I've done this presentation in various formats, but I've put it together, combined several things specifically for the group today. So what are we going to cover? Well, today we're going to cover business planning, because, and I'll say this a couple times, I believe that if you don't have a plan, most people wind up getting managed by other people who have a plan. And I'll be a little bit more specific about that, but you'll understand, I think, as we go through this, that having some sort of a plan is important. And then when you do your cash flow forecasting, you need to have certain assumptions that support the business plan and where you're getting your information and why it's credible. I'm going to talk about what I view as the 7 C's of obtaining capital. Most lenders that you talk to will see it as only 5 C's. But I've really, after many years, been convinced that there's at least 7, even though they may not actually, the lenders may not actually call it as 7, but they behave as though there are 7. So I'm going to talk about the factors that demonstrate a business of value. I'm going to talk about the biggest causes of failure of a small business. And then we're going to go into the details of the financial discipline system that I've created that identifies as part of the keys to success, and then the cash flow forecasting. And I'm going to wrap it up with what our research has determined are the 3 biggest keys to success. So with that, we will get to a Q&A, which will be at the end. And Lisa will be able to share a little bit more about that when that comes out. All right, let's start with business planning. You know, one of the things that we work with most of our clients on at the Small Business Development Centers is putting together a business plan. And if you go to the templates that you can discover or find, either Googling them or going to the SBA website or even our own SBDC website, we typically you will typically find that these things come in 30, 40, 50 pages as templates. And so one of the things that we've learned is that a lender or an investor or even somebody that you're trying to convince to be involved in your business and wants to look at your plan is never going to read any more than 10 pages. That's just a reality today. So I've created what I view as the short form business plan. And the way it works is this: starts with who are you for a page. And that involves an opening 1-sentence pitch, 50 words or less. One of the things that you would typically refer to as the elevator pitch. The second is the company mission and vision. What is the business actually committed to doing? The next one is the management team. Who are the owners and who will manage the business? And then what is the legal entity of the business and why did you choose that particular one? You can put all that together in one page. I don't believe that you need to have an executive summary. This is really what covers that and covers it in a more concise way. What are you going to do? Page 2. The company overview. What's the main purpose of the business, including its products, services, unique features, intellectual property, proprietary technology. And then one of the things that is typically not found in any of the business plan templates, but I certainly include here, is what I refer to as the risk analysis and mitigation. If this business fails, how is the lender, the investor, or anybody else who might have some financial interest in the business, how do they get repaid or made whole? You might as well be honest about it. Be absolutely fair. This is why the lenders ask for collateral. One of the things that you'll see as you look for funding or capital investment from anybody is that they're only going to lend when the risk is something that they understand and can manage, or if they're an investor, what's the return on their investment? And so if the business fails, how do these people get repaid or made whole? And you might as well just be open about it. How will it work? Right? This is a third page. Market and competition analysis. Who will buy and how do you know? Everyone is not an acceptable answer. Project execution. Can you put down a bulleted list of everything you need to do from day one? And this isn't just for a startup. This is for an existing business that's trying to do something, right, and get started at that. The marketing plan here is the product, price, place, and promotion. What is the plan? And then how is the business going to run every day? And you will notice here that I've got 4 items that are marked with these blue numbers, 1, 2, 3, and 4. These are the 4 key things about the business itself. Can you describe in 50 words or less what the business really is? The hook that would grab somebody literally if you're going to meet them in the elevator or find them somewhere else. Company mission and vision, right? Number 2. And then what does the company actually do? The products, services, unique features. And then in the operations, how does it actually run every day? Do you operate 7 days a week, 5 days a week, right? What is the actual business and descriptive, that description and how it functions? These are the things that I would recommend that you put down in 3 pages, and you've got to write it well. I often say you need to make sure that you thought through this, that you write it well, you describe each of these items, and keep it within the space of a page. But write it as if you were Edgar Allan Poe, where you take out a word and it loses the meaning, right? If you write things really well and people read 3 pages, they've got a really good sense of what your entire business is about. But there's another page that has to come into play here. And that is what are the assumptions that are needed to support who you are and what it is that you're doing. Can you illustrate your industry and market knowledge? What's the industry description and the outlook, size, growth rate, trends, characteristics? And this is true for whatever it is you are planning to do, you are doing, whether or not you're starting, whether or not you're trying to grow, right? Because these things change over time. What is the need or gap in the target market, and how does your solution fill it? Expanding market, what is the rate of growth? Are homeowners or other businesses spending an average X on your product or services annually? What's the pricing and research on comparables? Major factors contributing to projected success, including knowledge and skill of the founder and the uniqueness of design. Marketplace needs the product is trying to satisfy, how products and services meet these needs. What are the specific consumers that you will serve? The target market, distinguishing characteristics, the needs of the customers, demographics, and where they are located. The competitive advantages, location, personnel, efficient operations, ability to bring value to customers. I got this list directly from lenders who work to try and answer all of these questions about a potential borrower within the underwriting process. And as you may know, if you try to borrow any money from a commercial lender, the underwriting process is one that you actually never wind up getting to talk to that person. You may talk to the banker or the person whose job it is to get paid a commission for selling the loan, right? That's who you initially talk to. And then they send your application to the underwriting department or the credit manager. And these are the things that they are trying to determine. And so as you think about how you're going to write your plan and put together your description here on page 4 needs to cover these particular topics. And the better that you do it, the more likely you are to get somebody who'd be serious about considering what it is you're needing. So my view, as I'd mentioned, that there's really 7 C's to financing. And as I've said, bankers often use the 5 C's, but I've learned that they really focus on these 7 topics. The first one, and probably one of the most important, is a cash flow. It's the global analysis from all current ventures, realistic projections, the financial forecast for the purpose of the loan, and personal spending patterns. So it's a global cash flow coverage. I use and have been provided something called a global cash flow calculator. And the idea here is to develop something that's referred to as the debt service coverage. In other words, if you take all of your business operations into consideration and your personal spending, so it's a global aspect here. In the end of the day, there's personal guarantees on almost all commercial lending, which winds up making it all more personal than just business. And so the debt service coverage, the calculator actually develops a ratio, and with a numerator and a denominator. And the idea here is to have a coverage level of about 1.25 or better. That's one of the terms that we use when we're talking about debt service coverage. And that debt service coverage, that numerical ratio, that calculation that the lender uses, is one of the key factors. It's even at the end of the day more important. It determines how much excess cash is there for you to be able to pay on the debt and still pay yourself. So collateral, this was something that I utilized when we were talking in the day of the Flex Fund, but it's not required for traditional loans. But today, and by the way, for those of you that might be interested, we were using this and doing this presentation for the Flex Fund when it was out, which was at the end of 2022, a fund that was financed in part by Washington State and utilizing some federal funds from ARPA to provide low interest lending before the interest rates actually started to rise. The Department of Commerce, through the small business, the state small business credit initiative, SSBCI, is about to produce Flex Fund 2 coming sometime after the first of the year, which hopefully will also be a low interest loan for qualified borrowers. And it may or may not require some collateral. Traditional loans do require collateral, which is, as I mentioned, one of the backup things that's under the risk and mitigation factor. Capacity, how much experience related to the business does the borrower have? 2 years is the minimum, 3 to 5 years is better. Condition, what is the money going to be used for? What is the business plan? Capital, how much risk is the borrower willing to put into it? Credit, high credit score is above 720 help, but the business story is the key. So whatever it is that you've got going on, the actual story that you might have is real important as you talk about the story of your business, who you are, what you do, all of those items that I had on the previous slide. And then when you get down to character, to what extent has the borrower adopted the principles of the EMF and has the desire to learn, refine, practice solid business skills? If you haven't read the EMF, I strongly recommend that you find the EMF Revisited by Michael Gerber. I can actually show you that. It's one of the things that we require most of our clients to obtain and read. This is called the EMF. And the EMF stands for the entrepreneurial myth. And the entrepreneurial myth is that somebody who is good at something can also run a business. That's the myth, right? It's a story of a woman named Sarah who is making pies. She's working 60 hours a week and can't make enough money to pay the rent. How does she get to her dream of owning multiple pie shops? And it talks about that awkward phase of moving from being a business that's really a hobby or a lifestyle business, right? The characteristics of a hobby or a lifestyle business is one in which the business is solely dependent upon the owner. If the owner gets hit by a bus, the business typically is over. Recently, from the SBA Office of Advocacy, which produces data-based reports, determined something that I've been saying for quite some time and is essentially true across the US. For people who are, on average, non-professionals, by that I mean non-doctors, lawyers, CPAs, those that are advanced degrees, professionals, and licensed by the state. But those who are just, and I shouldn't say just, who are doing small businesses that really kind of fit the hobby or lifestyle category, the average income is about $50,000 a year. And what that means then is that and that's the take-home pay of a small business owner. That is somebody who is doing most of the work working in the business instead of on it. So that person winds up working, many hours, 60 hours a week, and there's honor in hobby or lifestyle businesses. In the United States, more than 2/3 of all those with a business license fit that category. And of all of those that fit that category, as I said, 2/3, these are people who $50,000 a year, they're committed to what they do, they love it, they don't want to go on vacation because why would I do that? I'd much rather just stay and do what I love to do so much. So there's trade-offs in that, and there's honor in a hobby or lifestyle business. But people have to decide what it is they really want their business to become, right? And so one of the things that I learned when I was doing this work during the Great Recession, when I had as many as 6 people in my office a day, most of them in tears, having lost, nearly everything, in many cases, their homes and whatnot. So I ran across a broker who shared with us, besides the financials of a business, what are the things that somebody wanting to sell their business, that business should look like, and somebody trying to buy a business, what should they be looking for? And this guy gave us the factors that demonstrate a business of value. And so the things that I've been using for quite some time, a business of value is one where the owner is obviously working on the business and not in the business. And what that means is that somebody has put together the systems that are necessary to make that business operate. And we're going to talk in a few minutes here about one of the most critical systems that I refer to as the financial discipline system. The second is where the owners are working less than full time, meaning that they view themselves as the creators, managers, and tweakers of the business systems that can operate without them having to be doing it all the time themselves. Really, truly the difference between working on a business, not in it. Third one is where there is a consistent growth and a well-established history, even during recessions or in this most recent case, a pandemic, where you've got businesses that have a consistent growth, may be flat during that time, but businesses that are going up and down, right? Their financials, their operations are consistently kind of swinging back and forth, are ones that where clearly the systems in the business just don't work very well, right? That's a real good indicator that the business is not stable, right? Even during recessionary times, the systems are not being paid attention to, are not working very well. The next one is where there's a diversified customer base. And in fact, this one and two down from this, a business that is a niche service or a product. The reality is that the most successful businesses ever are those that have a niche service or a product that appeals to a lot of people, a very diversified and broad customer base. Right? When the Apple phone came out, it was a very niche thing, but it instantly appealed to a lot of people and took off, which is certainly evident today. Below the diversified customer base is a business where there's a limited reliance on any key employee. A limited reliance on a key employee, that means that it has a really good human resources management system to recruit, hire, train, manage, and lead. All the elements of a human resources management system. And there's a limited reliance on any key employee, such that if that key employee left the business or got hit by a bus, the business isn't going to suffer. The ability for the business to continue to function regardless of, and that doesn't mean that you don't have key employees. You do. It certainly doesn't mean that you don't care about your employees. You really do. And in fact, the very best businesses care an awful lot about their employees, but they're not so dependent upon anybody that the business is going to suffer substantially if they leave. I had a client that was operating a boat boat repair business over on the peninsula. They bought this, thought it was going to be their retirement effort, and paid a substantial amount of money to buy the business. But there was two employees that had been working in the business for 15 years, and they simply didn't get along. And those two employees at some point quit, and the owners who had purchased the business with the belief that they were really good at marketing and that would solve most of their problems, simply couldn't do it. Within 2 years, they sold the business and lost the money that they had invested. The next one is a business that is in a niche service or product. I talked about that. And then finally, a business where there's a significant barrier to entry, right? That is where you've got either intellectual property, patents, trade secrets, copyrights, or if you don't have any of those things, you've got trade secrets. And trade secrets, in my experience, are actually fundamentally more useful and valuable than for small businesses than going through the whole process of trying to patent things, which certainly is, can produce really good barriers to others getting in. But you've got to think about what is your skill, what is your niche, what is it that you do differently, and how do you do it that provides a better experience or a better service or a better product for the customer. Real important when you're thinking about how do you develop a business of value. And then last but not least is where a business has no perceived skeletons in the closet. It just so happens that the perceived skeletons in the closet are also the three primary causes of failure of a small business. And on average, these are the three causes of failure. The first is a failure to collect all the money, accounts receivable and cash controls. What that means is that if you've got receivables at all, the best model, by the way, are those that are paid up front in full. Many retails, you can't leave the store without having paid in full. That's the best model. Sometimes you can do that in many service businesses or businesses that sell wholesale. You have to produce invoices and billing, which means accounts receivable. And if that money comes in 15 days, really truly a best practice. In 30 days, probably okay, but not a best practice. 60 days, 120 days, 180 days, and so on. What happens is you're spending money before you get the money in. And even a delay of 60 days can be very damaging to a small business, right? And oftentimes you wind up trying to get a line of credit, which is similar to a credit card, where you borrow the money to cover the working capital cycle, so that when you're in the down cycle before your money comes in, you can pay your bills with that. You then just have to pay back that line of credit during the up cycle, right? And not, and you've got to pay it back in full during that up cycle if you're going to continue to make that work as a financial plan. The next is a failure to manage the inventory. And this means both physical inventory and capacity. So this applies also to service or product businesses. But the single biggest cause of failure, for instance, of a food-based business, and oftentimes of a construction-based business, where the inventory is purchased and stored before it is sold, right? And we're going to talk about the importance of managing this from a financial perspective in a minute. But failing to manage the inventory, and in a service-based business, it's your capacity. If you've got a service-based business and you can do, 20 things or meet 20 customers a week, but you're only doing 15 or you're only doing 10, then the inventory is your capacity. And if you're not meeting what your overall capacity is, right? And if your capacity grows above, then you hire additional staff to fulfill the additional capacity. So how you manage that capacity is essentially the inventory of a service-based business. And the last one, which is one of the things that I ask almost every new client that I meet for the first time, is how often do you check your bank account? Those who have to check their bank account every day, and I've got many who wind up checking it more than once a day, that's a clear indication that they cannot produce regular GAAP-based, that's generally accepted accounting principle-based financial reports. All right, so when you get through all of this, and by the way, if you when you get to the Q&A here at the end, certainly wouldn't mind, a lot of this stuff, it might be really obvious to many of you, but please, if you've got questions, and you maybe put them in the Q&A or let Lisa know, and we'll address those questions at the end. So jot these down as you go through. I'm not answering questions as I go through this, but I will at the end to help you understand. So now I'm going to talk about financial discipline, and I'm going to talk about why that's important. First, it's a primary defense against any kind of fraud, right? If you know what's going on with your money, you can be passionate about your business. You can believe in what it is that you're doing. You can have technical skill, which is what the E-Myth Revisited is all about, right? And that is that somebody who's actually good at something can also run a business, right? Well, if you are paying attention and people, including your employees and your customers, know that you're paying attention because you've got financial discipline, it's the primary defense against fraud. It's the basis for investigating issues in the business. So the business owner can better manage and tweak all the business systems. It is the basis for strategic planning in the business. It helps to enable better management analysis and improve business operations. And it reduces the possibility that good people can become dishonest because the business owner is not paying attention. I've got the better part of a filing cabinet full of cases where people have lost money because they just trusted a bookkeeper, they trusted their internal accounting person, they trusted key employees, and what happens is if the owner doesn't have financial discipline, isn't paying attention, people can get sucked into because of their need when they know that they can get away with it. It increases the possibility that good people become dishonest when the business owner is not. So having financial discipline reduces that possibility. All right, what's the financial discipline system? So as a key question, how often should small business owners review and analyze their financial reports? First of all, you've got to get them, right? But here's the true answer to this, and I'll tell you why. You have to do this weekly, 52 times a year without fail, even if you're on vacation. There are so many people that I talk to that don't even produce financial reports until the end of the year when they have to do their taxes, right? And one of the things that I often ask, how much money did you spend on your CPA to actually complete your year-end tax return? $2,000, $3,000, $4,000, $5,000. That's a clear indication that you're paying the CPA to clean up your books so that you can actually get the taxes done. If you're only paying somebody $300, $400, $500 to get your taxes done, that means that you've got a really good set of books and you've got really good financial discipline. And why weekly? Well, if you do it monthly because you think you should, or in many cases, I've got clients who just do it quarterly because they think, well, I probably ought to look at these. The problem is that at monthly, the data in those reports, because of the cycle, can be as old as 60 days. That's most of the summer here. And you really can't do the kind of due diligence and solve the problems, right? Get the answers to the questions that you have if you do this, on a monthly basis. If you do it weekly, the data can be as old as 14 days. In a case like that, it makes a lot more sense because 52 times a year without fail, you actually have the chance to solve the problems, get the answers to your questions. And we're going to talk about just exactly how important it is that you do this as you go through it. So the success rates of businesses that produce, review, and analyze financial reports annually, really, this is what I was just saying. When they have to give their accounting records to their CPA to do the taxes, have the lowest chance of long-term success. Monthly, because they have come to believe that they should, data can be as old as 60 days. Weekly, 52 times a year without fail, best practice, data can be as old as 14 days. And as you go through your financial reports, a best practice is to use a tool that I call margin management, right? And here's the tool. So I'm going to take some time to talk about this. As you see here, this is a percent of gross revenue, right? This is somebody who is really doing a good job as a manager, as running their business, or somebody who's not. And this is as an example of a product-based business. The same can be done for a service-based business, right? Just as easily. But the point here is that somebody who's paying attention to all of the things, Cost of goods sold, say it's at 30% of the total gross revenue. Payroll is only 15% of the total gross revenue. They've done a good job managing their lease. And the lease is one of the toughest things. If the gross revenue goes down, you can reduce cost of goods sold, right? Or manage it better, or, buy less because you'll have less to sell because you got, for whatever reason, you've gone into a period where people are not buying what it is that you're selling. You can also reduce payroll, and you can reduce all other, like utilities, marketing, insurance, etc., all the other categories, all put together. Say that's at 10%, but the lease is the one thing you can't change. Once you've signed it, it's very difficult to do that. We did have some luck during the pandemic with landlords who understood that their businesses were closed and couldn't conduct business for a period. But we also had many whom that was really difficult. And oftentimes the landlords themselves have got a mortgage that they have to pay for. And so they really can't, provide rent reductions very easily. In any event, let's put all these together, and they total 63% of the gross revenue as an example of somebody who's doing a really good job. And that leaves you and debt, right? 37%. Now, somebody who's not doing a good job, who's taking their eye off the ball, their cost of goods sold, because they weren't paying attention, grew to 50%. Because they had issues, they had to hire more employees. Payroll grew to 25% of their gross revenue. They made a really bad decision on the lease. I can't even tell you how many people I talked to, and I've got a background in leasing. So I got into all of this in the beginning. I can't tell you. So many people say, well, this all looks standard. This all looks, reasonable to me. And have gone ahead and signed the lease. Here's the reality in commercial leasing. Real important. In the state of Washington, and in fact, in most states, there is no landlord-tenant law for commercial leasing. There is no law that says what has to be in the lease, and there's no law that says what's fair or unfair. The law is whatever the lease actually says when you sign it, right? And it's so important to realize that there is no such thing as a required lease or a standard lease, right? Just not the case. So you add up all these, somebody who's not paying attention has been made some mistakes, all right? And the total is 115%, which means that they are funding the business rather than taking money from the business, right? So when that's the case, and there's so many people who wind up with Ann Zimmerman and myself who are in the situation where they're maybe break even or maybe they're funding the business, right? And this is a tool that you can use in your financial reports every single week when you look at it, so that you know whether or not your cost of goods sold is actually going up over time, or your management of the inventory is good. Same thing with payroll and all the others, right? You can control a lot of those, and if you're paying attention to them, right, it makes sense. So now I'm going to go into the financial discipline system. Now I'll go through this kind of slowly, but feel free to jot down any questions that you have as you go through it. And this is the kind of thing, to be real specific about what it entails, is there's a lot of people who do in fact produce, maybe monthly, maybe sometimes even weekly, financial reports, but they just don't know what to do with them, right? So I've created what I call this financial discipline system, as an actual system that if you employ it and you stick to it as a systematized thing, it reduces the amount of time that you have to spend studying your reports, still doing it on a weekly basis, and it becomes really clear to everybody that you're dealing with that you know what's going on in your business. All right, so step one, as you go through the week, you collect all of the business revenue and income records, customer payments, deposits, invoices, point of sale reports, etc. These records can be in some kind of printed form, or you might be able to utilize and figure out ways to make this digital electronic downloads. But let's just say, for an analogy and as an example, you manage to get all of these in some kind of printed form, and you place all of these records into the proverbial fishbowl on your desk, right? That file or that place where you just make sure that all of these wind up in a certain place as you go through the week. And then is step two, you do the same thing with all of the business expense records, receipts, cash, credit, online, however you spend money. These records can be in some kind of printed form, or if you can figure out how to do these digitally, place all of these records into the proverbial fishbowl on your desk, so that these things are all in one place. And then every single Wednesday, whether it's you or somebody else in your organization, 52 times a year without fail, takes the contents to a well-established, multi-client, good reviews and references, working out of a business location bookkeeper. You have to avoid friends, family, neighbors, your spouse. So many times the owner is doing this themselves, or their spouse is, or their significant other is, right? Or in many cases, they've used the really nice lady next door who is doing this in their basement, around some other work that they do. The reality is that you've got to have somebody who is well established, has a lot of clients, good reviews and references, working out of a business location. Somebody that you can actually deliver and make sure that all of the data gets to them every single week. And I'm giving you a system that I am describing certain days of the week. You can do whatever works for you in your business, as long as you do it 52 times a year, every single week. By the way, one of the reasons why you avoid using family, right, or a spouse, let's just say you're the business owner and you're going off making decisions about your business. And now you've got somebody who's really close to you, maybe somebody that you're married to, who is keeping track of the money, the finances. Maybe sometimes it's even you yourself, and you're doing this. Very, very hard to have a good conversation that doesn't jeopardize the relationship when you're screwing up and making bad decisions, bad choices, and the horizon for your financial picture looks bleak, right? Very difficult to compromise. You wind up compromising those relationships with family people, right? So that's one of the things that I've experienced with my clients many times. And when they finally do get this information, and another reason why you have got to use one of these well-established bookkeepers, you need somebody who is on an annual basis continually getting updated about changes in GAAP accounting, which is the generally accepted accounting principles, which are established by a federal board called the Federal Accounting Standards Board, we refer to as FASB, right? And so these things get, from time to time, changes get made or things get clarified, and you want somebody who in fact is on a regular basis keeping up on that stuff. It shouldn't be a business owner's job to study and learn GAAP accounting, right? The owner's job is to run the business, not become somebody who's a study of GAAP accounting. Even if you use, a system like QuickBooks or Xero or Wave or one of the many other accounting systems, even if you use one of those that tends to put things into GAAP accounting basis, right? You still have, whoever it is has to, when they do the data entry, has to figure out the categories and the things that it goes to. Even if you do digital downloads, you still have to be on this and making sure that things are getting categorized and put in the right place. So step 4, from Wednesday afternoon to Friday afternoon, the bookkeeper completes all that data entry. It has to be good and well documented. Who, what, when, how much, what account, and what category, right? As I just mentioned. And so it may mean that you have to get all this data to the bookkeeper and you make notes on it that identify what all this is so that the bookkeeper knows how to account for this. And it may be that you have a quick conversation with the bookkeeper to clarify any questions that bookkeeper has as they do the data entry. It should not be the job of the business owner or somebody in the business owner's family or the key employees to do this data entry, right? This is really a data entry function. It has to be done properly, but it's still, that's what it is. Step 5, every Friday afternoon, 52 weeks a year without fail, the bookkeeper emails back to the owner a set of reports, a profit loss, a balance sheet, a cash flow statement, an accounts receivables report, an accounts payable report, and an inventory report, right? These are the critical reports. And I'm going to talk a little bit more about these as we get into the cash flow forecasting part of what we're talking about today. But profit loss, balance sheet, a historic cash flow statement, an accounts receivables report, accounts payable report, and an inventory report. If you do all of those things, the balance sheet is always going to tell you how much cash you have, right, as an asset in the bank, all of your cash elements. The accounts receivable is how much money is due to go out, and the accounts, how much money is due to come in, and the accounts payable is how much money is due to go out, right? If you are getting these and you're looking at them on a weekly basis, you don't need to log on to your bank account every day to see how much money is there. Because if you're logging into your bank account every day, I recognize that as an indicator of potential failure of the business, because it means you aren't producing these reports, right, on a weekly basis so that you don't have to look at your bank account every day. So think about your own processes, think about what it is that you're doing, right, and see if you can develop a financial discipline system that will work on a weekly basis, right, where the data gets to a bookkeeper, the bookkeeper enters the data, the bookkeeper sends you these reports. And then as an example, right, every Sunday morning, 52 times a year, you take those reports and you spend 90 minutes reviewing them. Do not spend more than 90 minutes on this. If you spend more than 90 minutes, right, you're not paying attention, you're being distracted. It's got to be 90 minutes once a week, whether it's Sunday morning, Sunday evening, Saturday afternoon, Monday morning, right? It has to be in a time where you are devoted, and maybe if you've got a partner business, it's you and the partner who are devoted to actual studying the financial reports, right, that I just described in step 5, the financial reports that you get 52 times a year, and you study those reports. And then you make 2 separate lists. I'm going to talk about what those lists are for, right? But you've got to put down these lists, and you've got to make sure that on those lists, you identify in the first list everything on those reports that you do not understand or that does not make sense. And so that's step 7, right? The first list is everything on those reports you do not understand and that does not make sense. And what's the key determiner for what goes on those? For every number that you cannot capably and fully describe to your mother, that has to go on the list, right? Don't be in denial, right? Don't ignore it. If you don't understand the number, put it on the list. In the beginning, your list is going to be long. But on Monday then, as an example, you go to work to get the answers of those questions. This becomes your education in your financials and general oversight of your business. Again, the first list is everything that you do not understand or does not make sense. When you walk in on Monday and you start asking questions about your financial reports and you're trying to understand how money gets spent that you didn't realize was going out, right? Or income didn't come in that should have come in. This becomes your oversight of your business. And when you start asking questions, people suddenly are paying attention to the fact that you know what you're doing. And you're an owner who's paying attention to what's going on. At the end of the day, you can be really good at what you do. But as I was telling you about the E-Myth, you can't serve your passion, right, if you don't pay attention to the money. At the end of the day, it's always about the money. All right, I mentioned 2 lists. On the second list, you write down everything you do understand, but you do not like. This list then becomes the basis of the changes to your 12 to 24 month cash flow forecast. Everything that you do understand, you just don't like it. And you use this to produce an actual forecast. And what's a cash flow forecast? Well, on page 1, you might produce the first 12 months. Page 2, you might go through years 2 through 5. Or in the first page, or on a digital spreadsheet, you may go 12 months or you may go 24 months. It's really kind of up to you. But this is cash only by items list. We're going to see this on the next 3 slides. And this is all cash, including paid receivables and all cash out except the owner's salary or draws. You're going to show when the business will break even and generate profits. It's going to include details in the text portion of your business plan on your assumptions that I described earlier in the presentation of why and how you will get the sales you're projecting. There are cash portions of the profit and loss statement and cash portions of the balance sheet. And only a true cash flow statement shows both. A cash flow forecast becomes a plan because one of the very first things I said tonight was a person without a plan always gets managed by others who have one. And I see this all the time, right? One of the key things you've got to remember is that everybody you deal with, right, be yourself, your investors, your lender, your vendors, your employees, your customers, your bookkeeper, your attorney, your insurance agent, right? Everybody that you deal with one exception, everybody that you deal with has a financial interest in your business. And their first job is to run their business, not yours. That's even true for a customer who's trying to make a purchase decision or not. The first job that they have is to run their business, not yours, right? So at the end of the day, the owner is the only one in charge of their business. And the only person that they can work with who does not have a financial interest in their business is a technical assistance advisor like myself or Ann Zimmerman, who's my colleague on with us today, can work with you because you don't pay us to do that, right? So a technical assistance advisor, and we're not consultants, we're just advisors. We teach business skills, we don't do the work for somebody. And so that trusted technical assistance advisor, maybe mentor type person, is the one person who does not actually have a financial interest. And oftentimes we can tell you things that the others that have a financial interest in your business typically would not tell you or can't tell you. So a cash flow forecast becomes the plan. And a person without that plan always gets managed by others who have one because they all have that agenda to be running their business, not yours. So how do you do a cash flow forecast? This is a visual of the template that you should all have received from Lisa, right? And so we're going to talk about the key elements of this. And as we go through this, and you have questions, as you should, be sure and jot those down. Be more than happy to get to those during the Q&A. What we're talking about here is an actual beginning bank balance. Can you see my pointer? It's on the actual cash that's in the bank. And keep in mind, this is forecasting. You never put actuals in this. This is your future plan. This isn't what did happen. This is what's you believe is going to happen. So you start off with the beginning bank balance. And then you project paid receivables. And so somebody who doesn't get paid till the end, right? The best thing that you can do is to try and change the business model so that you get paid in stages. And then your receivables is only 15 days or 14 days, maybe even less in some cases, right? And you make sure that you have systemic processes to ensure that you get paid quickly. And I say that because people who are invoicing, and this can be true in most service-based businesses or product-based businesses doing wholesale, when you're invoicing, it's hard enough to be in business. We've been talking about all the things that you've got to think about as a business owner. And it's hard enough to be in business. It's even harder to be in the collections business, right? So you have to project, if you are for any of these product, like a wholesale business, paid receivables, like a service, when do you actually get the cash, right? If you invoice somebody in this month and you know you're not going to get it until this month, your projection goes here, not here. Make sense? You would change all of these to be the product lines of whatever business you have. And so that template that you've got, and by the way, in that template, you've got to make sure that the math is correct. I don't vouch for any of the formulas in there. And then you have here the total cash from the operations. This income in the orange, this is what is the income that's posted on a profit and loss, right? That profit and loss report. This is the operational income of the business. So you've got total cash coming in from operations. Then you have other cash in. You may have member investments. You may have term loan proceeds. And you may have other income. Maybe you sell some equipment, right? These are cash in that show up on the balance sheet, not the profit and loss. So my point here, again, is that there's cash portions of the balance sheet and cash portions from the profit and loss, and I identify that down here. Then you have a total of the total cash in. Then you have the total cash in for the month, which includes the total from other and the total from operations income, right? That's the total cash income from the month. And you project all of these out through every month. And if you get good at this and you look at it every single week and you update it, you may not make a change every week, but if you update it every time that you learn where something here might be off. With the clients that I've worked with, many over the years, can get to the point a year later, 2 years later, when they are actually predicting accurately what winds up happening in the business. And they discover that their prediction a year out or further was within 1 percentage point or less. It's really pretty amazing. The other thing that winds up happening with this is that for you to get to a break even or a better, you've got to determine how you're going to generate this income. This becomes your marketing and sales strategy. How much money do you actually need? And it might be product selection. It might be changes to your service that are going to generate more money. That becomes your strategic planning for your business. It determines how you're going to make money, what it is you're going to do that brings in money, and what's going to need it, so that it covers all of the cash out things. And so what are the cash out? Hopefully you can see this, but let's say advertising, marketing, auto expense. Bad debt is when accounts receivables, you have to write it off as an expense because you never did get paid. Bank charges, commissions that you might have paid on sales. Contributions, something that you might have paid money to the local soccer team or to your charity. Cost of goods sold labor. Here's real important. All labor, but only the labor that is directly connected to the sale of your products or services, becomes cost of goods sold labor. Cost of goods sold other is not product that you sell. It is non-inventoried product, bags, um, wrapping, um, stuff that you put in shipping boxes and, peanuts and whatnot. Cost of goods sold other is stuff that is part of the sale, but it's not inventory. You're not counting how much you have. Dues and subscriptions, auto insurance, auto business. This is real important. If you borrow on a term loan and you're making monthly payments on it, one of the things that you know is that in the beginning, there's a lot of interest and only a little bit of principal. At the end of that term loan, there's a lot of principal and only a little bit of interest. So each month, the interest, and you see here in this example, the interest expense is the only portion that goes on to the profit and loss. Only the interest portion of a term loan shows up on the profit and loss, not the entire payment, right? So here the interest portion is decreasing a little bit each month. Licenses and permits, meals and entertainment, merchant fees, office expenses, postage and printing, professional fees, your rent or lease, right? Repairs and maintenances, taxes, which might include B&O tax. Also you've got to cover payroll taxes, right? All of those might categorize here. You might separate these out into the various tax elements. Your telephone or cell phone plans, your travel, your utilities. Wages is all of your administrative wages that are not directly related to the sale of the products. And then you've got miscellaneous, right? So these are all of the expenses that show up on a profit and loss, right? These are operational expenses. And you have a total, right? Total expenses. All right. Now we've got other cash out, which is the principal portion of a term loan payment, right? And you pay more of that each month. You pay less interest each month. You pay more principal each month. That's the way term loans are designed. Line of credit payments, which would oftentimes be the non-interest portion of your credit cards. And here's the biggie, inventory. You cannot call cost of goods sold or cost of goods sold when it in fact hasn't been sold. And you cannot manage your inventory if you call it cost of goods sold when it hasn't been sold. Again, you cannot call cost of goods sold and post it on a profit and loss when in fact it hasn't been sold, and you cannot manage the inventory. Everybody in a product-based business is going to have inventory shrinkage. You can't avoid it. It comes from everything from samples to damage to theft, right? What's the biggest inventory shrinkage in a restaurant business is the loss of alcohol, right? Funny how that just sort of, much of it just sort of disappears. Well, that's your money going out the door. So you have to have a method of managing the inventory. The only way that you can do that is when you buy the inventory, it gets posted as an asset on your balance sheet. It's an asset on your balance sheet. And then when it gets sold, it's a non-cash transfer to the cost of goods sold on your profit and loss, which is why cost of goods sold, right? Inventory cost of goods sold is not an expense listed on a cash flow forecast, because the money actually goes out when you buy the inventory, right? Right here. The money goes out when you buy the inventory. Very important. Equipment purchases, vehicle purchases, total other cash out. This cash out right here, this whole section is the cash out portion of a balance sheet. So again, there's cash portions of the profit loss and there's cash portions of the balance sheet. And it's important that you learn this and recognize it, and that you then begin to forecast this over time so that you can develop a plan. And now you've got total other cash out. You combine that with the total expenses here, right? And from the profit loss. the other cash out from the balance sheet gives you the total cash outflow, right? Then you've got the total income, cash income, right? Less the total cash, ending cash position for the month gives you the total cash outflow, right? Well, excuse me, the ending cash position. So now you've got the ending cash position, which hopefully more money came in than went out, right? And hopefully that's positive. Oftentimes it's not, but hopefully that is. And then you have the very beginning bank balance that you had. That combined with the ending cash position gives you the ending bank balance, right? So it's important that you recognize how that math works in that template that I've provided for all of you. Okay. I'm going to talk about now the most important keys to success, and probably wrap in a few other things before we go into the Q&A, and we can open this up, and I'm more than happy to answer questions about any of this, and we can go back to particular portions of this slide deck and talk about whatever it is that you want to cover. But one of the things that we've learned through all of our research is that there are three things that determine somebody who is likely to be profitable through 10 years. And the reason why this is important is that statistically in the United States, 80% of all small businesses fail in the first 5 years. Of all of those who get a business license, 80% are essentially ended within 5 years. What most people don't know is that of the 20% that make it, 80% of those fail in the second 5 years. So that the number who can actually get profitably as a business of value through 10 years is only about 8 or 9%. And lenders know this. That's why they are very concerned about who they lend money to, right? Because they're concerned about the risk. So what's the likelihood and the elements for somebody if they're going to be one of those who can actually beat the odds and be profitable through 10 years and even on a growth phase? The first is a desire to constantly collect data, do research, and seek mentors. Even those who are profitable through 10 years are still saying, what's going on with the industry? What's going on with the economy? What's going on with my customers? What's going on with my employees? They are constantly collecting information, seeking data, doing research, talking to mentors. They're never coming from the position that they've got all the answers and this is the way it is. And when they do this, right, and have this desire to constantly collect information, then they know when to make a pivot in the business, right? They can develop a strategy where their product or their service can pivot into either a new product, a new service, or a new set of customers, right, or a new target market. And they can pursue that and make a pivot because they've recognized and they're collecting the data constantly and know what's going on. The second is the understanding that the business owner's primary job is to create, manage, and tweak the business systems. I've mentioned this, and it's been a consistent theme through all of this. It's the underlying principle behind the E-Myth, the book that I showed you. And that's the understanding that the job, right, and this is how you work on the business instead of in the business. And that's to create, manage, and tweak all of the business systems. And so number three is the deal breaker for most. And that's having the desire to have at least as much fun studying, practicing, learning, refining that completely separate set of business skills that you can go and apply to any business that you were really interested in. You have to have the desire to be a business person as much as you have the desire to be good at whatever your business does, right? If you do that and you really want to be a business person, then we can be much greater help to you because our primary job as technical assistance providers, and I'm really speaking about the SBDC and the many other technical assistance providers that we have around the state, there's nearly 400, who provide some level of technical assistance. And my colleague Ann Zimmerman and I are one of those. We can do a better job of helping you if you actually have the desire to learn business skills, because that's what we do, is teach business skills. Right? So as I mentioned, the entrepreneurial myth is someone who is good at or passionate about something that can also run a business. So the SBDC, we've got now 33 locations all around the state of Washington. Our business model is designed so that we're within a 2-hour drive of every small business in the state. We can see you in person. We can see you virtually. We've got a lot of people who are located in the greater Puget Sound area, including myself and Ann Zimmerman. The fastest way to get a hold of us is through our website, right, at wsbdc.org, contact an advisor, or washington@wsbdc.org, and or 833-492-7232. And that's how you get to us if you're interested in pursuing one-on-one, fully confidential advising at no cost to our clients. All right, Lisa, with that, I think I can turn it back over to you.
Okay. Well, Steve, thank you so much for a ton of information. To digest that, I mean, really, it's going to take a little bit of time, right? So I do say, although you got a ton of information today, the resource is there. The resource of the Small Business Development Center. Steve brought home some great points. To be really passionate about something and then run a business, they're totally two different things. I can say that from past experience, and also when Apex has clients that come through the door wanting to do government contracting, they'll say they're very passionate about something, and we definitely listen to why they're passionate about it, and most always they're going to talk to a Small Business Development Center before they get into government contracting. It's essential to have a sound business before you get into government contracting. This was a subject matter that was asked to be discussed when it comes to government contracting, because government contracting is challenging in getting into it, but being financially sound is essential to be successful within.
And all of these things that I went through, particularly the whole process of cash flow forecasting, is essential to every business. And even in government contracting, government agencies don't want to do contracts with weak businesses. They do, in effect, do a form of underwriting to determine whether or not the business has the capability and the capacity to be able to service that contract and not fail at it in the middle of it.
That concludes our session for today. I want to say thank you to all that attended today, and Steve for presenting the information about financial considerations. It's really important that you're financially sound to get into government contracting, and knowing that the Small Business Development Center is a resource for you and how to get a hold of them is very important, as well as Apex, what Apex can do for you as far as getting into government contracting. Are you ready? What is it going to take to get ready? And also in selling to the Port of Seattle, is the Port of Seattle buying what you're selling? We help with that. We, meaning Apex, helps you understand, does market research to understand where your product is being or service is being bought. With that being said, I want to say thank you again, and we're going to conclude our session for the day. I hope to see you at the resource fair, which is next week on Tuesday. Have a great night.